Here's something that shocks most people. Nearly half of all pension recipients say they were completely blindsided when they saw their first tax bill in retirement. Half! And not by a small amount. We're talking hundreds, sometimes thousands of dollars more than they expected. So before you count on that pension check to fund your golden years, you need to hear this. In this video, we're talking about pensions, specifically what the IRS has planned for your pension money before it ever hits your bank account. And trust me, the IRS absolutely has a plan. The question is, do you? Stick around, because by the end of this video, you'll know exactly how to protect more of what you've earned. Let's start with the big picture. A pension sounds like a dream, right? You work hard for 20, 30, sometimes 40 years. Your employer promises you a steady paycheck for the rest of your life once you retire. Done deal. Except, it's not that simple. Here's what most people don't realize. Your pension is considered taxable income by the IRS. It doesn't matter that you earned it over decades of hard work. The moment that money starts flowing into your account, the government wants its cut. And here's where it gets tricky. A lot of retirees plan their entire retirement budget around that pension number. They see $2,500 a month and think, great, that's what I have to live on. But after federal taxes, state taxes in many cases, and potentially Medicare surcharges, that $2,500 might look a lot more like $1,900 or even less. That gap between what you expect and what you actually receive, that's the IRS's plan. Not a conspiracy, not some hidden trap. It's simply the tax code doing exactly what it was designed to do. And if you're not prepared for it, it can seriously derail your retirement. Okay, so let's actually break down how pensions get taxed, because not all pensions are treated the same way. First, defined benefit plans. This is the classic pension. Your employer promises you a set monthly payment based on your salary and years of service. In most cases, 100% of that payment is taxable as ordinary income. Why? Because the contributions were made pre-tax, meaning you never paid taxes on that money going in, so you pay taxes on it coming out. Second, defined contribution plans. Think 401ks and similar accounts. These work a bit differently. If you contributed pre-tax dollars, distributions are fully taxable. But if you contributed after-tax dollars to a Roth account, qualified withdrawals are tax-free. Big difference. Third, early withdrawal penalties. If you pull money from most retirement accounts before age 59 and a half, the IRS hits you with a 10% early withdrawal penalty on top of regular income taxes. There are exceptions, certain disability situations, substantially equal periodic payments, but in general, touching that money early is expensive. Fourth, required minimum distributions, or RMDs. Once you hit age 73, the IRS says you must start taking money out of traditional retirement accounts, whether you need the cash or not. And those withdrawals? Fully taxable. Miss an RMD, and the IRS hits you with a 25% excise tax on the amount you should have taken, and that drops to 10% if you correct the mistake within 2 years. And don't forget, your pension income can also affect how much of your Social Security benefits get taxed. If your combined income crosses certain thresholds, up to 85% of your Social Security can become taxable. So it's not just about the pension in isolation, it's how everything adds up together. Here's the part most financial content skips over, and it's the most important thing in this entire video. You have more control than you think, but only if you plan ahead. Let me give you 3 specific things you can do right now, or before you retire, to keep more of your pension money. Number 1, adjust your withholding. When you start receiving pension payments, you'll fill out a W-4P form. That's the withholding form specifically for pensions and annuities. You can choose how much federal tax gets withheld from each payment. The mistake most people make? They go with the default, or they withhold nothing at all. and then get hit with a surprise tax bill in April. Take 20 minutes, do the math, and set your withholding right from the start. Number 2, consider a Roth conversion before retirement. If you haven't retired yet, or you've just retired and have a few lower income years ahead of you, this is a golden window. Converting some of your traditional IRA or 401k money to a Roth IRA means you pay taxes now at potentially lower rates, and everything grows tax-free after that. Your future RMDs also shrink. It's one of the most powerful strategies in retirement planning, and not enough people use it. Number 3, time your other income sources strategically. If you have multiple income streams, Social Security, a pension, investment withdrawals, the order and timing of when you take each one matters enormously for your tax bill. For example, delaying Social Security while drawing down a traditional IRA first can reduce your lifetime tax burden significantly. This is where working with a fee-only financial advisor or CPA who specializes in retirement can genuinely pay for itself many times over. The bottom line? The IRS isn't doing anything wrong. They're following the tax code. But you don't have to be a passive participant in that process.
Let's bring it home. Your pension is a fantastic retirement asset, but it's not a tax-free one. The IRS treats most pension income as ordinary income. Early withdrawals come with penalties, and RMDs can push you into higher tax brackets if you're not careful. The people who come out ahead in retirement aren't the ones who earned the most. They're the ones who planned the most. Understand the rules. Adjust your withholding. Think about Roth conversions. And if your situation is complex, get professional guidance.
Now I want to hear from you. Are you currently receiving a pension? Have you already felt the sting of that unexpected tax bill? Drop your experience in the comments below. Your story might help someone else watching this video right now. And if you found this useful, hit that subscribe button.